Well, thank you all, and especially thank Hampshire College and Second Nature for hosting this conference. It's a great opportunity for me to come here and talk about something that I'm very passionate about. An article in Rolling Stone magazine recently described Bill Gates as viewing the world as a giant operating system that just needs to be debugged. I thought that's kind of a scary thought, but also perhaps particularly appropriate as we try to deal with climate change. Because the essence of what needs to be done is to change incentives, which in practice simply means changing a few lines in the tax codes around the world. Not having appropriate incentives to conserve on the production of emissions is certainly a dangerous bug. This? I've got, this doesn't, is this on? Okay, good. Okay. So not having appropriate incentives to conserve in the production of emissions is certainly a dangerous bug, and it's a high priority global risk management problem. My topic tonight is why society's need to fix this bug has implications for intentionally designed endowment strategy, which tries to align investment practices with institutional values. My understanding is that educational institutions have a very long multi-generation horizon, and that a big part of the education mission is to use knowledge for the betterment of society. And in particular, I would guess that sustainability is a central component of the environmental, social, and governance factors which inform your investment decisions. When you consider the economic implications of climate risk, there is an opportunity for you to tilt your endowment portfolio in a direction that enhances your fiduciary responsibility, to minimize risk while generating the highest possible return, and at the same time, aligns your portfolio with a sustainable climate policy. As you will see, this is not a message about divestment of fossil fuel assets. In fact, what I would really like to do is to help you to take advantage of the psychic energy that some of your stakeholders have directed toward what I think is a counterproductive divestment movement, and direct it in a much more productive direction, that is toward creating appropriate incentives to reduce emissions. Scientists have sent many very clear messages about the risks of climate change. A productive next step, I think, would be for educational institutions, as part of their mission to use knowledge for the betterment of society, to highlight to the public why the creation of appropriate incentives for the conservation of greenhouse gas emissions is an urgent priority. Let's begin with a recent message from the American Academy for the Advancement of Science. In a very unusual step, the Academy recently directed its message to the public rather than to member scientists. The message is from a report called What We Know, and the topic is climate change. And the question I will address tonight is this: are there, in this message about climate risk from the AAAS, any implications for how you manage your endowment assets? We addressed this question a year ago at the World Wildlife Fund, where I serve on the board and chair the investment committee, and we decided the answer is yes, at least for us. And I hope the exercise of thinking through the economic implications of climate change may also have implications more broadly for how you think about building sustainability into all your investment decisions. What we did at the WWF was very simple. We tilted our portfolio in such a way that it will benefit if investors' expectations shift toward a realization that emissions will be priced rationally sooner than the market currently expects. Later, we'll talk about two alternative braking scenarios designed to address climate risk. One is complacent. The other recognizes risk and uncertainty. At WWF, our portfolio is now positioned to benefit from the scenario which recognizes uncertainty. We profit from any move in investor expectations away from irrational complacency in the direction of rational behavior. The recognition of the reality of climate risk, when it gets reflected in the market, will have valuation implications for certain assets in our portfolio. Our hedge protects our portfolio from this revaluation, but more importantly, it sends a message that our mission requires us to support the creation of appropriate incentives to conserve on the production of greenhouse gases and positions our portfolio to benefit from that revaluation. We are doing everything we can to create these necessary incentives, and our portfolio is positioned to benefit to the extent that we are successful in moving this agenda forward. Obviously, we would like you to position your portfolios in alignment with ours, and then we'd like to work together to fix this bug. At the WWF, we recognize that climate risk is a rapidly growing, serious global threat to everything that we love, to all of the ecosystems we're trying to protect, to all of nature as we know it. And that's the message from the scientists as well. I'm a risk manager, and I understand very well what needs to be done. Incentives matter. Having the wrong incentives is a bug in the operating system that needs to be fixed. Pricing risk appropriately is the essence of risk management. What do I mean by that? Perhaps it's obvious, but in the 20 years that I've worked in risk management, no one has ever asked me to minimize risk. The institutions that hire risk managers are risk takers. A risk manager not only quantifies risk, but more importantly is tasked to look for situations in which risks are not priced appropriately, situations in which you're not getting paid appropriately for the risk you're taking. This form of risk management, getting paid appropriately for the risks you take, is at the heart of successful investing. Climate risk is not being priced appropriately by society. It doesn't even have the right sign, and that's the essence of the problem. Globally, the government incentives to create emissions through massive subsidies to the consumption of fossil fuels dwarf the small incentives that exist in some locations to reduce emissions. Globally, the brake is not being pressed. Government incentives are firmly planted on the accelerator. And where some governments have tried to create appropriate incentives, these incentives are under fierce political attack. Pricing climate risk appropriately, globally, is the critical step that society can take today. It's the critical step that society must take immediately to eliminate the threat from climate change. It is irrational for the world to continue to misprice this risk, and more generally, this step of pricing climate risk appropriately is just the first of many such moves that need to be taken to develop sustainable economic policies. The fact that society has created irrational incentives which are today inducing growing and dangerous pollution of the atmosphere is an urgent risk management failure. There are many reasons why other educational endowments have decided not to act, but having been down this road with the WWF, what I want to do for you tonight is to try and take all those reasons off the table. And I would, by the way, at this point, like to introduce a couple of the folks that were very instrumental in putting on this action that we took. The CFO from WWF, Michael Bauer, is here. I think Michael back there. And we worked with our consultant, Cambridge Associates, and Tom Mitchell, I think, is here, over here. And Cambridge was very helpful in moving forward with us, which is something that we really wanted to do. Now, I'm going to show you a simple step that that the World Wildlife Fund has taken to protect its endowment and to highlight the urgency of pricing climate risk. I'll explain why we did what we did, and I'll suggest why it might be a strategy for you to consider. To do nothing ignores both an opportunity to hedge a risk in your endowment and also an opportunity to address this global threat to the environment. This is a risk which has been ignored for far too long. But the first thing I want you to understand is who I am and why I'm so grateful for the opportunity to be here tonight talking to you. I'm an economist who happens to have spent a career in financial markets focused on risk management and investing, and who is now focused on climate risk. I'm best known as the co-developer of the Black Litterman Global Asset Allocation Model, but I'm not going to talk about that. I have advised and continue to advise many investment committees, including for 6 years being an advisor to the GIC, the Singapore-based sovereign wealth fund, which is one of the largest and most highly respected investors in the world. I spent 23 years at Goldman Sachs, and I was the partner that Goldman asked to build their first global risk management system back in 1994. This background in pricing and managing risk and investing with a long horizon informs my understanding of the issues associated with climate change. I look at climate change from the perspective of risk management, and I hope this background allows me to provide a slightly different context for addressing this issue than you might have heard before. I think, and certainly hope, that we are near a tipping point in terms of addressing climate change. And that's why I'm very anxious to enlist your help, while hopefully we still have time, to try and push global society to a new equilibrium in which all economic activity is performed in a context in which there exist appropriate incentives to conserve on the production of greenhouse gases. Although it's not a high priority for most people, a clear majority understands and accepts what scientists are saying, that climate change is real, is caused by human activities, and needs to be addressed. The next step is to understand what needs to be done to fix this bug, to educate the public that what needs to be done is to build support for policies that create appropriate incentives, and to create the public consciousness that will allow society to address this rapidly growing global threat. One of the most important things that being a risk manager does is it trains you to think about the worst case scenarios. It does not make for gentle sleep, nor does it make for pleasant conversation. But I do want to draw your attention to this new report addressed to the public from the American Association for the Advancement of Science. The report, What We Know, was widely covered by the press when it was released 2 weeks ago. You'll easily find it if you Google AAAS What We Know. Let me quickly read you a few paragraphs from this report issued by a panel of the most respected climate scientists of the AAAS. Quote, "We consider it to be our responsibility as professionals to ensure, to the best of our ability, that people understand what we know. Human-caused climate change is happening. We face risks of abrupt, unpredictable, and potentially irreversible changes with highly damaging impacts, and responding now will lower the risk and cost of taking action." They go on to say, "Earth's climate is on a path to warm beyond the range of what has happened over the past millions of years. The range of uncertainty for the warming along the current emissions path is wide enough to encompass massively disruptive consequences to societies and ecosystems. As global temperatures rise, there is a real risk, however small, that one or more critical parts of the Earth's climate system will experience abrupt, unpredictable, and potentially irreversible changes." The report continues, "Disturbingly, scientists do not know how much warming is required to trigger such changes to the climate system." So that's what the scientists know to be true, and obviously we should be listening carefully to what they're saying. But economists also bring an important perspective. We do know what needs to be done to address this problem. Consider the following question. Should climate risk be priced appropriately? Or put more concretely, should people face appropriate incentives to conserve on the production of greenhouse gases? It's not some well-developed moral or ethical issue or stance that makes the answer to this question yes. The bar is not that high. In fact, one would have to be irrational to answer no to this question. Because although it sounds like a question, it really isn't a question. The statement is a tautology. The answer is yes, climate risk should be priced appropriately because of the meaning of the words should and appropriately. Everything should be priced appropriately. The only interesting question is what's the appropriate price? The financial mathematics that deal with pricing risk has developed considerably in the last several decades. And although the math is complex, the basic concepts and our understanding of what needs to be done are very straightforward. First of all, what needs to be done is very clear. Appropriate incentives to conserve in the production of greenhouse gases need to be created immediately for all 7 billion global economic agents, whether they are acting as consumers, producers, investors, or entrepreneurs. If there's one thing that economists agree upon, and there is, it is that incentives matter. Incentives drive behavior. My undergraduate degree from Stanford University was in human biology. I wanted to understand human behavior from the perspective of biology. We are all biological organisms, after all, part of life on Earth. But I realized early on that if you truly want to understand human behavior as we see it in the world around us, then you also need to understand economics, how incentives lead to actions and outcomes. So I studied economics in graduate school at the University of Minnesota in the late 1970s, a particularly exciting time and place. Many of us were focused on the implications of rational expectations. 3 of the people I knew well at Minnesota have gone on to win Nobel Prizes in economics for their work on rational expectations, including both of my advisors. The basic question we were trying to address was, what would happen in a world in which everyone acts rationally based on the information that they have, and at the same time understands all of the implications of their actions and the actions of others, including the government? Now, you might think that's a crazy question to even ask. Many people do. Very few economists understand these complex models, much less all agents in the economy. And very few people act perfectly rationally, nor do they understand all the implications of their actions. So why might one care about such an idealized world? But what we thought made these theories interesting was the idea that over time, a rational expectations equilibrium could become a kind of center of gravity, that with a little help, rational expectations equilibrium could become a self-fulfilling prophecy. After getting my degree at Minnesota, I taught economics at MIT for 2 years, and then I spent a career applying those lessons in the financial markets. Now let's return to climate risk, and let us focus for a moment on what are the appropriate incentives to conserve on the production of greenhouse gases. First of all, why should there be such incentives? These incentives should exist because the act of polluting creates the potential for damage in the future. Carbon emissions create those unpredictable, potentially irreversible, abrupt impacts with massively disruptive consequences that the AAAS climate panel warns us about. Such potential catastrophic damages are examples of what economists call an externality, a cost associated with the pollution which could significantly harm the lives of those who live in future generations, which isn't otherwise included in the price. So how large is the appropriate incentive to conserve on emissions? Of course, no one knows exactly what it is. Economists have a name for this appropriate incentive, though. We call it the social cost of carbon. The US government recently estimated that the social cost of carbon is $37 per ton of carbon dioxide, up from their estimate of $21 in 2009. An even earlier UK government study headed by Sir Nicholas Stern estimated the value to be $85 per ton. In my view, these estimates give you an appropriate sense of both the level and the range of uncertainty about the value of the social cost of carbon, and also a sense of how it has and will continue to evolve over time as we get more information. But what determines the value of the social cost of carbon? What considerations determine how large is the appropriate incentive to conserve on the production of greenhouse gases? Economics tell us what should determine its value. It's not ethics or ambition or anything like that. The rational determination of the social cost of carbon is simply the trade-off between consumption today and consumption in the future. This calculation is informed by science because science is the only reliable source of information about the potential for damages in the distant future. And this calculation is also informed by economics and financial markets, which tell us how to make those trade-offs, how, for example, to determine the present value of uncertain damages which might occur hundreds of years from now. It turns out that the appropriate discount rate depends on 2 characteristics of human behavior that we can observe in financial markets. The first is called intertemporal substitution. How do people value consumption today versus risk-free consumption in the future? We observe that trade-off most clearly in the interest rates of TIPS, inflation-protected bonds issued by the US government, the closest we can come to a real risk-free promise of future consumption. And the second dimension is societal risk aversion, which is best observed in the excess returns of equities, and which is also an important input that helps us to calibrate the appropriate price for climate risk. The puzzlingly large historical return on equities relative to bonds reflects an underlying high degree of societal risk aversion, which has an implication for the appropriate price of carbon emissions. Society, in its long-term investment decisions, is surprisingly risk-averse. That's important to know as we calibrate the appropriate price for climate risk. Greater risk and higher risk aversion both raise that price. Suppose, for the sake of argument, and to keep it simple, that for the moment we ignore uncertainty and risk. Consider a simple example in which it's known with certainty that a ton of emissions today will create $100 worth of damage in 30 years. Suppose also that we observe a risk-free 30-year interest rate of 1.3%, which is approximately where the TIPS rate is today. That interest rate is just another way of saying that for $67 we can buy a government liability today which will pay $100 adjusted for inflation in 30 years. The government creates that same $100 liability in 30 years' time if it insures the damage from the emissions, or if it issues the bond. And thus, they both have the same value today. So in this example, the social cost of carbon, the appropriate incentive to avoid the damage, is exactly the value of the future liability, which is the price of the bond, that is $67. Notice importantly that there's no need to appeal to ethics, morality, politics, or societal ambition in pricing this damage. When there's no uncertainty about the damage, what determines the social cost of carbon is simply a market interest rate, which is influenced by the many factors affecting the supply and demand for saving, such as the current stance of monetary policy and the desire of members of society to save for future generations, which together set the terms at which the government or any of us can transfer wealth risk-free from today into the future. But when the magnitude of the damages and the time it takes for them to take place are uncertain, then the calculation becomes less exact. But the social cost of carbon is nonetheless determined by the same considerations: science, economics, and the pricing of uncertain cash flows. There is a rich academic literature today called asset pricing theory, which informs us how we price such uncertain future cash flows. These are the considerations which determine the social cost of carbon, and risk is very much a part of that appropriate determination. The actual incentive today for conserving on the production of emissions is nowhere near the appropriate level. On average around the globe, the incentive does not even have the right sign. According to the International Energy Agency, there are over $500 billion in subsidies every year for the production and consumption of fossil fuels, primarily in developing countries. Since the global emissions of carbon dioxide are about 35 billion tons per year, on average, we have around $15 of government subsidy per ton of carbon dioxide emitted. The reality is that the total incentives to conserve on emissions that do exist around the world are an order of magnitude smaller than the incentives to create emissions. It is long past the time that this bug should be eliminated. Emissions should be priced appropriately, immediately. Now let's talk about expectations. It is well known, as I've described, that on average around the globe, climate risk is not being priced appropriately. But what is not so well understood is that today's equity markets build in expectations that climate risk will not be priced rationally for a very long time. Let's focus on that expectation of long-term irrational behavior, and let's think about how society might move more quickly to a rational expectations equilibrium in which emissions are priced appropriately. The market expects a slow increase in emissions prices over many decades. But what the market does not yet seem to realize is that this expectation, sometimes referred to as the slow policy ramp, is also irrational. What makes this expectation irrational is that it does not appropriately take risk into account. I want you to please hold on to that idea, that the slow policy ramp is irrational because it does not take risk into account. I'm going to come back to this idea because it is the key to understanding what you might want to do to protect your endowment. Think of the Earth's atmosphere as a reservoir with an unknown capacity. The historical level of carbon dioxide in the atmosphere was around 280 parts per million. We have now filled the reservoir to 400 parts per million, and it is rising at the fastest rate ever, around 2.5 parts per million per year. No one knows what the safe level is, and so the act of filling this reservoir is inherently risky. We can be confident that there is, at some point, a tipping point, a level at which catastrophic, irreversible damage becomes inevitable. We just don't know what that level is. That point of no return has a very uncertain probability distribution. Scientists have no idea when or where or how some unpredictable sequence of events will lead to positive feedbacks that create an abrupt, irreversible change in the Earth's environment. Moreover, the economic damages associated with crossing that first catastrophic tipping point are highly uncertain. That distribution of economic damages has what risk managers call an extremely fat tail. It's impossible to rule out damages much worse than what we expect. Because of that uncertainty, the remaining capacity of the atmosphere to safely absorb emissions is unknown, if indeed any at all exists. And however much capacity is left, it is a scarce resource, and yet we are today wasting that unknown capacity by refusing to incentivize conservation. The actual rational expectations path of emissions prices is not a slow policy ramp. The rational path is a sudden jump of global carbon emission prices to a level high enough that incentives are created that will, with extremely high probability, eliminate the threat of catastrophic climate risk. Of course, no one knows what the future will bring, but I think this rational pricing of emissions, this jump to a rational price path, will come much sooner than the market expects. One of the facts about markets that was drilled into my brain when I studied economics 40 years ago at the University of Minnesota was that it never, ever makes sense to smooth prices. If the appropriate price is here and the actual price is here, then the appropriate path for the price is an immediate jump to the appropriate level. Let's go back to that idea that I told you to hold on to, that the slow policy ramp is irrational because it does not take risk into account. The incentive to conserve on the production of emissions acts as a brake. It reduces the risk of crossing a tipping point down the road. We anticipate that dealing with climate change is going to be a long road, and we anticipate braking for a long period of time. But here's the key question. How should we expect the degree of braking to change over time? This expectation is called the forward curve of emissions prices. The answer to the question requires application of a complex mathematical technique known as robust dynamic optimal control in a context with highly uncertain nonlinear responses. But simple intuition can be just as effective in helping to chart the course. Consider two scenarios. I like to cycle in the mountains, so I'm going to use a bicycle analogy. In the first scenario, you're a cyclist racing down a downhill straightaway in the mountains. Toward the end of a grade, it gets steeper just before a sharp left curve, and there's a cliff off the outside edge. You're going fast, let's say 25 miles an hour, but you've been down this road many times, and so you know that you need to slow down to about 10 miles an hour to get around that curve safely. And you know exactly how far in advance you have to start slowing down to go into that curve. You know just where to start braking, and you brake slowly at first, increasing the pressure as you get closer to the curve. That's the profile of the slow policy ramp for emissions prices, which is built into current equity valuations. There's very little uncertainty in that scenario. The market, and many economists who I suspect have not adequately taken uncertainty into account, have suggested that this is the appropriate approach. You start slowly, and you increase your braking pressure over time as you get closer to the curve. Notice that in this scenario, when you start to brake is not so important, because if you start a little late, you can increase the braking a little more down the road. Now consider a second scenario. The situation is identical, except you've never been down this road before. And maybe you're going slower, 15 miles an hour, because there's poor visibility and the road is wet. Now, in the instant that you see the curve, you realize that you need to slow down. And suddenly you realize that the curve appears to be sharper now than it initially looked, and you don't know exactly what's the safe speed to go around that upcoming corner. as time compresses, you realize that because the downhill grade has gotten steeper, you've been speeding up, and you might be going much too fast to slow down in time, and you need to squeeze the brakes hard. The difference between scenario 1 and scenario 2 is uncertainty, and how you react depends on your degree of risk aversion. In scenario 2, you instantly brake hard enough that you hope and expect to ease up on the brake as uncertainty is resolved, and you slow down safely. That's the situation society is in today with respect to climate risk. We've never been down this road before, and surprisingly, the equity markets have not yet realized that. Not many companies seem to have thought much about the path of emissions prices, but all indications are that their expectations still reflect the slow policy ramp. For example, ExxonMobil, in its just released 2014 Energy Outlook, writes, quote, "Since policies to address greenhouse gases, and more specifically carbon dioxide emissions, will tend to raise the cost of energy and related activities, many countries are taking care in structuring both the nature and the pace of greenhouse gas policy initiatives." The Carbon Disclosure Project recently surveyed corporations and found many companies are beginning to use an internal emissions price as a planning tool. The average internal price is in the low 20s per ton of carbon dioxide emitted, with a wide range around that. And some policymakers have argued incorrectly that the act of pricing emissions will destroy the value of existing capital, such as existing coal-fired power plants. However, the truth is that it's not the pricing of emissions that destroys the value. It's the production of emissions itself that destroys their value. But what is true is that the actual lower value of those assets has probably not yet been realized. These power plants, and more importantly the coal that they burn, are what we call stranded assets. What will be destroyed when emissions are priced appropriately is not the value of these stranded assets, but rather the inflated and false valuation of those assets by the market today. This is a very important point. The creation of appropriate incentives to conserve in the production of greenhouse gases will not only change the behavior of 7 billion economic agents, causing them to appropriately conserve on the production of emissions, the creation of appropriate incentives will also affect the valuation of assets. There will be winners and there will be losers. And it's very possible that concern about catastrophic outcomes will lead to global pricing of emissions much sooner than the market has built into current prices of stranded assets. Rational pricing. That is a risk that exists in your portfolios to the extent that you own stranded assets. The reason a sudden jump in expectations of emissions pricing to a rational path makes sense is because the price of emissions is the brake, and the only effective brake that society has in order to generate global emissions reductions at the scale we need. Of course, there are plenty of frictions that have so far prevented creating appropriate incentives to conserve on emissions productions. Governments have shown very little ability to support any climate policy lately, especially the United States. Behavioral finance would emphasize the irrational behavior of individuals, the frictions that prevent policy, and so on. And some investors think people will never be rational. But it turns out behavioral anomalies, the opportunities that have been identified to take advantage of irrational behavior in the markets, once understood, often disappear. Risks that are not priced appropriately create opportunities for investors that bring those prices back into line. The opportunity that exists today, because climate risk is not priced appropriately, is in selling certain equities, such as coal and tar sands, which under the expected slow policy ramp for emissions prices still have significant valuations, but the prices of which will fall when it becomes generally recognized that carbon emissions will soon be priced more rationally. Now, I'm well aware that many of you have been pressured and continue to face pressure to divest all of your holdings in large fossil fuel companies. I strongly recommend not doing so. I see this campaign as a well-intentioned attempt to blame fossil fuel producers for their rational behavior given the irrational incentives provided by society. Now, I do not condone using shareholder-owned assets to try to spread disinformation about climate risk. And if fossil fuel companies are doing this, then it is a very significant governance issue. For example, when Peabody Energy Corporation, the world's largest private sector coal company, launched a sophisticated public relations and advertising campaign recently, extolling the virtues of coal energy for poor people, they were clearly and very cleverly trying to create additional frictions to prevent appropriate incentives from being established. Peabody argues that lack of access to energy is, quote, the world's #1 human and environmental concern. Some have argued that you shouldn't divest of companies like Peabody Coal because by owning it, you can influence management not to act in such a self-centered way, putting future generations at risk to protect their own profits. And while it's a topic for another occasion, I do think that there are also a number of very important positive steps that can be taken on the engagement side to push forward the incentive creation agenda. As just one example, the aviation industry is now moving forward with a global market-based measure to conserve on emissions from commercial aviation. However, many airlines hope to do so without creating appropriate incentives. As far as I'm concerned, a market-based measure, which doesn't create such incentives, is a fraud. But because airlines will need the capacity to burn fossil fuel for decades to come, it's actually in their interest now to lead the global effort to stop wasting the atmosphere's remaining limited capacity to safely absorb emissions. They need to hear this message from their shareholders. But there are limits to the ability of shareholders to influence behavior. I can't help recalling the famous quote from Upton Sinclair, "It's difficult to get a man to understand something when his salary depends on his not understanding it." And I can understand why you might not want to own Peabody Coal. I wouldn't either. On the other hand, it doesn't make sense to me to make a moral judgment about all fossil fuel companies. Rather, for me, it's primarily a question of valuation. Appropriate incentives to conserve in the production of greenhouse gases will create winners and losers, and coal assets certainly will be losers. In many cases, though, it's not obvious what the impact will be on a particular fossil fuel company. Take for the example the valuations of natural gas resources. Their valuations may be increased by the creation of these incentives. There may be a day when we stop cooking with natural gas, but that day is far in the future. I would advise continuing to hold on to such assets. The impact on any particular fossil fuel business will depend on its particular mix of assets and strategy. You may have seen this week that ExxonMobil made public a report concerning the risks that stranded assets pose to the company's business model, how the company is planning for a carbon-constrained world, and how climate risks affect capital expenditure plans and other related issues. ExxonMobil has been and will likely continue to make a pivot to a low-carbon energy production strategy and thus benefit from carbon pricing. In their report, Energy and Carbon, Managing the Risk, Exxon argues, for several years our outlook for energy has explicitly accounted for the prospect of policies regulating greenhouse gas emissions. This factor, among many others, has informed investment decisions that have led ExxonMobil to become the leading producer of cleaner burning natural gas in the United States, for example. Based on this analysis, we are confident that none of our hydrocarbon reserves are now or will become stranded, end quote. I don't know. ExxonMobil might be a stranded asset, or it might not. The point is that you can hedge the stranded assets risk in your portfolio much more simply by focusing elsewhere. There are obvious stranded assets. The value of coal and oil sands reserves, for example, are very likely to decline when emissions are priced. And while there may very well be governance issues that owners should discuss with ExxonMobil, there is not much a coal company can do to protect the valuation of its assets other than to try and prevent rational climate policy. While I doubt that the market risk created by stranded assets is a big risk for any of you, I suspect that your endowment, like that of the WWF, does have a small exposure embedded in its stranded asset to the risk that climate policy will become more rational. That risk creates an incentive for your institution to support the status quo. At the World Wildlife Fund, where I chair the investment committee, a number of our board members felt strongly that we should walk the talk. And so we had extensive discussions at the committee about how we could eliminate the risk of stranded assets and position our portfolio to benefit from the rational pricing of climate risk. The answer, as many of you who've confronted this issue know, is that it's not easy to sell the stranded assets embedded in your endowment. First, you have to identify them. Many such assets are illiquid and could be quite expensive to sell them. Others are in fund structures or in portfolios constructed by external managers. You might have to make very significant changes to the structure of the portfolio, which itself could be difficult and expensive. The truth is that the cost and disruption to the endowment of eliminating all these assets could be very substantial. Meanwhile, the risk itself is likely to be rather small. At the WWF, we decided, for the most part, not to disturb the assets in the underlying portfolio. There was one real asset fund, which included half of all the stranded assets we owned, and we discussed whether that fund made sense and decided to redeem from that fund. Then we identified and quantified the extent of the remaining coal and tar sands assets, which were rather small, about 1/4% of our assets, and we used a total return swap as an overlay to hedge those stranded assets, tilting the entire portfolio toward a stance that will benefit from the creation of appropriate incentives to reduce carbon emissions. The stranded asset total return swap is very simple. It's a very simple, inexpensive derivative structure. I have a couple of slides. Maybe we could put the first one up. The WWF agrees to pay our counterparty, Deutsche Bank, maybe the next slide. It's coming. There we go. WWF agrees to pay our counterparty, Deutsche Bank, the total return, price change plus dividends, from an index of 12 coal and 13 oil sands companies, plus a small fee. In our case, the fee is about $5,000 a year, or 100 basis points on the $500,000 notional value of the swap. That compares, by the way, with the initial estimate of the cost that we would incur if we were to divest of our stranded assets, which was about $250,000. Deutsche pays WWF the total return on the broad market, the S&P 500. Our choices of the two sides of this swap, selling coal and tar sands and receiving the market return, were dictated primarily by a desire to keep the structure as simple as possible. This structure creates cash flows to WWF, positive or negative, equal to the total return that would have been generated by a portfolio with the specified long and short underlying equity exposures. Thus, the swap creates the equivalent economic benefit of selling stranded assets at current valuations and investing those proceeds in the broad equity market. It is literally a bet that stranded assets that we have identified will underperform the broad market. We voted last May to use this simple total return swap to hedge the stranded assets embedded in the funds in which we have investments without otherwise disturbing the portfolio. And although it's only been in place for a few months, so far the stranded assets have underperformed the market, and as we anticipated, the portfolio has benefited from the swap. More important is that the swap has a number of attractive characteristics. Because it is both long and short equities, it does not change the overall equity exposure of the endowment. In fact, because stranded assets are more volatile than the market and have a higher beta, the swap has a slight negative correlation with the market, which means that at the margin, it slightly reduces the total volatility of the portfolio. But more important, it hedges the specific risk that emissions will be priced sooner and at a higher level than the market anticipates. Moreover, if stranded assets underperform the broad market, as I anticipate will happen as the global economy moves more quickly toward a rational equilibrium in which appropriate incentives to reduce emissions are put in place, then the swap will generate a positive return. And note that this outcome does not require that emissions actually be priced. The swap will pay off as long as investors' expectations of policy action on climate increase from the current very low levels. A final and substantial benefit of the swap structure is that it is particularly inexpensive and very flexible way to adjust portfolio exposures. There's no need to touch the underlying portfolio and no need to undo or constrain the investment decisions of your underlying managers. In fact, at WWF, we found that the most difficult part of all in implementing the swap was simply getting all the derivative contract agreements signed. So after considering a number of options, what we decided to do at WWF was to hedge the stranded assets in our portfolio using this stranded assets total return swap structure. And that's a step that I would recommend that you consider as well. If we could go to the next slide. There's no reason to be overly precise. There's no economic reason to size the swap to exactly hedge existing exposures. The point is not that there's a big risk that needs to be eliminated. Rather, the point is that at the margin, creating just a small exposure to this swap reduces risk, creates the opportunity for a positive return, and most importantly, better aligns the interest of the endowment with that of the institutional mission to encourage sustainable economic policy. And what you see here is just a back test of if we had had this swap on for the last 3 years, what would it have done? Well, you can see the S&P was up 15.9% annualized over that period. Tar sands were essentially flat. Coal was down 10%. And so the swap itself would have been up, would have created a return of 21.7% annually on the notional size. I suspect that many members of your communities have expressed concern that your institutions are not doing enough to protect your endowment assets from climate risk and to support a sustainable climate policy. And sadly, if your institution responds, as many already have, by arguing that there's nothing to be done with your endowment portfolio, that is not a satisfying response. First of all, the argument that there's nothing to do is just plain wrong. You can protect your assets very easily and inexpensively with this swap. But what is much more of a concern to me is that your institution would be missing an opportunity to better align the interests of the endowment with the mission of the institution. Like the WWF, educational endowments have a fiduciary responsibility to prudently invest their endowment. But also like the WWF, with a stranded assets total return swap, you can prudently hedge your endowment assets, create a positive expected return, and at the same time, serve the interests of the broader society to mitigate climate change. By hedging the stranded assets in your endowment portfolio, you can also send an important message to your stakeholders that says clearly the creation of appropriate incentives to reduce carbon emissions is a rational and important step in the movement toward a sustainable society. The swap recognizes the reality of climate risk and the need to create those incentives as soon as possible. Establishing the swap also provides an opportunity to explain to your community that by hedging the stranded assets in your portfolio, you are recognizing the urgency and magnitude of this risk management failure. And hopefully you can redirect your stakeholders to work with you to focus on the immediate task of addressing this failure by creating appropriate incentives to reduce the production of greenhouse gases. To summarize, the existence of irrational and inappropriate incentives to pollute the atmosphere with greenhouse gases is creating a global threat that requires an urgent response. This stranded assets total return swap can protect your endowment and refocus your institution's energies away from concern about your endowment portfolio holdings and in the much more productive direction of pricing climate risk appropriately. Creation of incentives to conserve on emissions is the critical step that society can take today to fix that annoying bug in the global operating system and move towards sustainable economic policies. Incorporating the stranded assets total return swap in your endowment is a small but potentially important step in that direction. Thank you.